Great job, gentlemen. My question is, so it sounds like your growth thesis is they're going to pave over paradise, and that's how they're going to, grow with development. What's the risk there? What's the pushback? I don't know who approves development. Is it at the county level or the state level? And have you talked to, any of those regulators? Is there going to be pushback against further and further, paving over Hawaii?
So we did not talk to anybody from the state. However, through our research, we found that the regulations go through both the city and the state as far as zoning and entitlement goes. However, we don't feel that it's a significant risk because of A&B's longstanding history in Hawaii, a significant taxpayer and large employer in Hawaii. It's built a goodwill with the state, which has helped ease the zoning process.
And furthermore, there's a significant demand for housing, both in the workforce and luxury segment of development and sales. For workforce housing, the state of Hawaii would need 60,000 homes to be built. Therefore, the state of Hawaii put in place initiatives to convert 5 to 10% of agricultural land holdings into residential land use.
My question deals with the fact that the company has like a business diversification with many different segments, and you value the company using like sum of the part. Haven't you considered using a discount? It seems to be like a holding company.
Okay, so the reason why we use some of the parts method was because we believe that each segment is unique in its business operation, and so that different valuation metrics would be needed in order to accurately value it. The reason why we didn't use a DCF overall for the firm-wide is because one of the segments, the development and sales segment on the real estate side, is cyclical in nature and therefore does not produce steady streams of cash flows. So we valued it in a different way by just using disclosed projects and doing an MPV on the disclosed projects.
And you didn't consider a discount after the sum of the parts?
Pardon?
After you sum of the parts, the investor is
Right.
buying basically a holding company.
Right.
Didn't you consider using a discount that applies sometimes to a holding company?
As for a discount, we use the discount rate in each of the valuation metrics, and we believe that there's significant upside in Alexander Baldwin. One thing that investors are not seeing in Alexander and Baldwin is that there's significant upside catalysts in each of the segments. And one of the ones I want to point out right now is that they have significant land holdings across the state. And with these significant land holdings, there's significant upside, as one of the buyers that we stated in our presentation was Mark Zuckerberg, and he purchased 360 acres of agricultural land on the island of Kauai for $100 million. And so these upsides we believe that these upsides negate any further risk of A&B being a holding company. So we added all of the risk variables into each discount rate and each multiple within the valuations.
Okay, maybe I misread it. Your debt had a pre-tax cost of 7.5, and your equity was 589.
Yes.
Shouldn't debt be cheaper?
The reason why we believe that debt is high, because they were once in a growth cycle, so they did raise a lot of debt, and they also raised a lot of equity. But in order to add the risk of that increased debt, we decided to add a premium to the cost of debt. And for the cost of debt, the way that we calculated in the beginning was using the spreads between its historical debts.
But so you're telling me the debt holders would require a higher demand rate than the equity holders?
Pardon?
Aren't the debt holders in a less risky position than the equity holders?
So you're asking, are the debt holders?
Yes, I mean, we typically think of the debt holders as holding a less risky position than the equity holders.
Right.
So therefore, we typically think of the equity holders decrying a higher required rate of return. But
Right.
you seem to have the opposite, and that strikes me as interesting.
So the reason why, what we incorporated into our cost of debt was the risk of rising inflation. And so because by adding that premium.
Wouldn't the equity holders have that same risk?
I beg your pardon?
Wouldn't the equity holders have the same risk?
I'm not sure as to sure what you're asking in that.
Okay, keep going, I'm sorry.
So you're asking if equity holders bear the same risk as?
Of expected and possible inflation going up.
Right, and so all of these risk variables were included into our WACs, into our segments, and to the EV to EBITDA multiple on the equity side. And on the debt side, we did do the process as explained. But because we believe that because we believe that they're in a high leverage period because of the growth cycle, that we believe that the debt would be a little bit more risky. And so in order to incorporate that into our valuation and to make it a little bit more accurate, we included that premium.
I have a question about the expected cash generation that you're looking for down the road. If I heard it right, I think you're expecting that at some point the company will begin or raise the dividend and do some stock buybacks. But is that based on any conversation with management about their plans? Is it just a possibility, or is it just as likely a possibility that they're going to acquire more land?
So as regards to the increase in dividends, so currently the strategy of Alexander Baldwin, as management has stated, is that right now they're experienced a high year of growth in 2013, and they want to use the recurring cash flows from their leasing portfolio as well as the Grace acquisition in order to fuel their development sales currently, as was in their earnings call, because this is their highest profit margin. However, because development sales is a cyclical nature, and it is hot right now, but it is going to cool down in the future as it is a cycle, we believe that after 2018, that A&B will want to give shareholders higher returns, as they have recently begun to issue a dividend, which is a very low payout ratio of only 5%. So we believe that when the cycle turns down for development sales and begins to cool off, and they still have the recurring cash flows from Grace construction as well as their real estate leasing, that they will want to increase their dividends.
Okay, well, you keep using the word.
Additionally,
Okay, go ahead.
from the real estate perspective, we did an analysis of the real estate market in the state of Hawaii, and there's usually a 10-year trend as far as real estate cycles goes. Since the 2008 recession, we have seen a recovery in Hawaii's real estate market, and there is usually a 3-year downturn and a 7-year upturn. Currently in Hawaii's real estate market, they're in the 3rd year of the upturn in the real estate market, and we do believe there's additional 4 or 5 years of real estate development to be done for Alexander Baldwin. If you take an analysis for the development sales projects, a lot of their projects are timed to finish at the peak of this cycle, and we believe they have the timing necessary to realize a lot of these margins in order to increase earnings growth going forward. However, we do believe as the development sales cycle slows down due to the real estate cycle, that there is going to be a dividend increase from the cash flows from their leasing as well as their grade specific construction segments. And we believe that if development sales does increase significantly in a 1-year occurrence, that there is a potential for a share repurchase due to what management has spoken about.
Okay, but you keep using the word belief, so I take it as something that you have surmised, but they haven't laid that out at
In the
management.
recent earnings call, Stanley Kuriyama, the current CEO of Alexander Baldwin, has stated that 2014 will be a year of development sales, primarily in Leeward, Oahu, and Windward, Oahu. Because Hawaii's real estate market is there is a significant demand base because of the housing shortage across all islands, and a lot of the real estate development on Oahu has been reaching a lot of high price points. We do believe going forward, development sales is going to increase due to management's discussions from their earnings calls in recent Q4.
Okay.
Macroeconomic risk, most of the growth in the Hawaiian economy is tourism. The biggest growth drivers is Chinese visitors from China. Have you looked at Chinese economy slowing? Have you looked at that and considered that as a risk factor here?
Yes, we did look to that as a risk factor, but what we found that's actually a value upside. From our analysis, we've seen that there is a 300% increase in Chinese visitors since 2008, and going forward, it's projected to continue this upward trend. And as for on the other side of real estate development and sales, there's significant upside from China through luxury real estate property investments. And what eases this process is the further decrease in stringency of capital flow laws within China and from capital from China to abroad. And so because of these less stringent laws, more Chinese investors are investing into Hawaii real estate. And this has been going on since, this has been increasing 15% year on year, and going forward, this is projected to increase at the same rate.
Additionally, from a strategic standpoint, A&B has luxury developments in most of their areas, as well as workforce housing. In regards to the luxury development, they are targeting high-end, wealthy, affluent individuals in foreign real estate market, in foreign countries, as well as the U.S. mainland properties.
Would you still have a buy if China was going into a recession?
Yes, Yes, because China is only one of the demand sources for real estate in Hawaii. Asia Pacific as a region as a whole is a very strong demander. There's a lot of Australian demand and Japanese demand. But not only that, there's mainland US and Canadian demand for Hawaii real estate. Again, we want to point out that only 360 out of the 5,000 acres that we stated in our presentation were bought by Mark Zuckerberg for $100 million alone. And so with A&B's significant land holdings in the island of Kauai where the transaction occurred,